$1 billion in net income, one single quarter, from a company with a franchise drug that has had no real approved competitor for nearly a decade. That is Vertex Pharmaceuticals, and they technically just missed estimates.
They missed the revenue estimate by $7 million on nearly $3 billion in revenue. That is less than a quarter of 1% off consensus. Whether that constitutes a miss is a question worth examining.
Revenue came in at $2,987 million against the estimate of $2,994 million. The EPS came in at $4.06 versus the $4.23 consensus. On the headline numbers, this is a miss on both lines.
I want to push back on the framing here. A $7 million miss on $3 billion in revenue is analyst models running slightly ahead of reality, not a business deteriorating. The operating margin held at 38.1% GAAP. Net income cleared $1 billion. The machine is running exactly as designed.
So the headline says miss, but the actual business delivered a 38% margin and $1 billion in profit in a single quarter. Lana, walk us through what actually happened in the quarter.
Revenue was $2,986.9 million, up 7.8% year over year. The estimate was $2,994 million, so the miss was $6.1 million, under a quarter of 1%. Not a number that reflects business deterioration.
EPS and margins, what did those look like?
GAAP EPS came in at $4.06. The consensus estimate was $4.23, a miss of 17 cents, or roughly 4%. Operating income margin was 38.1% GAAP. That is not a number you see often in pharma or most industries at this revenue scale.
Where does that 38% margin come from structurally?
Trikafta is a triple combination therapy for cystic fibrosis, and it effectively has no approved competition in the target patient population. Once patients begin therapy, retention is near complete. The economics look more like enterprise software than traditional pharma. High margin, high retention, and no significant incremental cost per patient served.
And net income, what did that come out to?
Net income for the quarter was $1,030 million. On $3 billion in revenue, that is a 34.5% net margin. Very few companies in any sector run at that level consistently.
Pipeline, where does Casgevy fit into the picture?
Casgevy is the sickle cell gene therapy approved late 2023, co-developed with CRISPR Therapeutics. Revenue contribution is still early. The commercial launch is progressing, but gene therapy is a slow-build market requiring specialized treatment centers, complex patient identification, and insurance negotiation. It is not yet material to the quarterly total.
So the core CF franchise is still carrying the entire revenue story.
Trikafta and the extended CF portfolio are the engine. Casgevy adds pipeline optionality. Beyond that, Vertex has assets in acute pain and kidney disease, none near-term revenue drivers, but evidence the company is systematically redeploying cash flow into adjacent high unmet need areas.
We opened with $1 billion in net income, and that is the real number to anchor on here, not the $7 million miss.
The surprise for most investors covering this name is how durable this has become. Trikafta launched in 2019. 5 years later, operating margins have not compressed, the installed patient base is still growing, and no competitor has achieved regulatory approval in the target population.
Most franchise drugs face margin erosion over time as competition enters. Vertex has managed to hold that dynamic off for the better part of a decade.
The structural insight is that cystic fibrosis is rare enough that the scientific investment required to reach triple combination therapy created a position that is practically impossible to replicate quickly. Vertex had a 15-year head start in the underlying science. That combination of disease rarity, regulatory difficulty, and first-mover depth built a moat that is not theoretical.
And the cash that franchise generates funds the next bet, Casgevy, pain kidney, without needing to raise capital or dilute shareholders.
That is the compounding mechanism. Free cash flow funds the next pipeline cycle. The tiny miss versus estimates is noise. The underlying model is one of the most resilient in biopharma, and most investors looking at the headline miss are misreading the signal.
How does Vertex compare to the rest of the specialty pharma and rare disease space?
Regeneron and BioMarin are the closest rare disease comparisons with public scale. Regeneron runs gross margins above 80%, but has meaningful revenue concentration in Dupixent, a single antibody for atopic dermatitis and related conditions. BioMarin focuses on enzyme replacement therapies with lower margins and faster growth. Both are excellent businesses, but neither combines Vertex's scale and margin profile simultaneously.
So the position is scale plus margin, which most rare disease players do not have at the same time.
Most rare disease companies are either profitable at small scale or growing fast but not yet profitable. Vertex is profitable at large scale, nearly $3 billion in quarterly revenue at 38% operating margin. That combination is almost unique in biotech.
The valuation reflects that, though.
Vertex trades at a meaningful premium to peers. For a company generating over $1 billion in quarterly net income with no meaningful debt and a pipeline that does not require outside capital, the premium is defensible. The risk embedded in the valuation is whether the pipeline can sustain growth as the CF franchise matures toward its patent horizon.
Regeneron faces a similar question. What comes after Dupixent if it faces biosimilar competition?
Exactly the same structural question. For both companies, the next decade of growth depends on whether pipeline bets convert. Vertex has Casgevy as an early answer. Regeneron has Dupixent extensions. Both are high-quality problems to have.
What is operationally working for Vertex right now?
3 things. Trikafta access is continuing to expand geographically. Each new country approval adds revenue at near zero incremental cost. Operating efficiency is intact at 38% margin, which has not compressed year over year. And the balance sheet is clean. No meaningful debt, strong cash generation, and the capacity to fund the next pipeline cycle without diluting shareholders.
Where is Vertex structurally exposed?
Patent duration is the main structural risk. Trikafta's core composition patents run into the early 2030s. Not immediate, but the commercial life of the franchise is a finite timeline, and the market has to see a credible growth story beyond CF to sustain current multiples.
And Casgevy adds a different kind of execution risk than a pill franchise.
Gene therapy commercialization is operationally complex in ways that Trikafta is not. Patient identification requires specialized testing. Treatment is done once at qualified centers. Reimbursement negotiation for a one-time $7 million therapy is a different conversation than a twice-daily pill. The upside is enormous, but the ramp is inherently slower.
We opened with $1 billion in net income from a franchise with no real approved competitor. That is still the Vertex bottom line, and a $7 million miss on estimates changes none of it.
Watch Casgevy patient enrollment velocity in Q2 and any pipeline disclosure on the pain or kidney disease programs. Revenue quality at this level is not in question. The debate is whether the growth rate can be sustained once the CF franchise matures. If you want full earnings coverage from us this week, STRL, Duo, PINs, and more, subscribe to Charged Alpha.
We will see you on the next one. This episode is for informational and educational purposes only and does not constitute financial advice.
Charged Alpha is not a registered investment advisor. Nothing in this episode should be construed as a recommendation to buy or sell any security. Always conduct your own research and consult a qualified financial professional before making any investment decisions.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.